Look at the statistics across retail brokers, and a stark reality emerges. Upward of 90% of new retail Forex accounts lose their entire capital base within the first few months. The mechanics of currency exchange operate without bias, yet the market consistently isolates and exploits predictable human behaviors. Beginners often approach the charts expecting a rapid wealth generation vehicle. They look for immediate payouts. Professionals view those same charts through a strict lens of capital preservation, focusing on mathematical risk limits before they even consider profit targets. To understand why this disconnect happens, we need to track the exact chronological life cycle of a single retail trade. Moving step by step from the initial setup to the final outcome exposes the specific moments where a beginner's discipline fractures. A blown account is rarely the result of one massive external shock. It is the mathematical conclusion of a predictable sequence of unforced errors. Phase 1 is preparation. The first error occurs when a trader boots up their platform and starts scanning currency pairs without a predefined strategy. When there is no written plan to dictate the rules of engagement, technical analysis degrades. The traders start seeing patterns that confirm what they want to happen, replacing objective observation with emotional guesswork. Institutional traders operate differently. They define strict criteria for their entries, their exits, and their invalidation levels before the trading session even opens. That preparation leads directly into Phase 2, capital allocation. This is the moment the trader decides exactly how much money to put on the line for the chosen setup. Here we see the second major failure point. Driven by impatience and a desire for quick returns, the beginner risks 10, sometimes 20% of their total account balance on a single position. This chart shows the mathematical devastation of that decision. At 10% risk per trade, a completely normal 5-trade losing streak removes nearly 50% of the total account balance. Mathematical recovery from a drawdown of that magnitude requires a 100% gain just to return to the starting line. By contrast, capping exposure at 1 to 2% per trade preserves the capital base. The drawdown curve flattens out, allowing the account to absorb a string of losses and survive to catch the next profitable trend. Surviving the setup phase demands that these mathematical boundaries are locked in place before any capital is exposed to the live market. Phase 3 is market entry. The order is executed, the capital is live, but price action consolidates into a tight, slow-moving range. The lack of immediate feedback breeds boredom. To manufacture a sense of action, the beginner commits the third error, overtrading. They open multiple new positions, often in highly correlated currency pairs. This action inadvertently multiplies their risk exposure. A single macroeconomic data release will now trigger losses across all those correlated positions simultaneously, while the trader steadily drains their own capital, paying unnecessary broker spreads. The solution requires treating patience as an active, measurable trading skill. High-frequency execution depletes accounts. Strict adherence to high-probability setups preserves them. We then move to Phase 4, active management. The slow consolidation breaks, and momentum suddenly shifts aggressively against the open position. Faced with an immediate drawdown, the beginner commits the fourth error. They trade without a hard stop loss because their ego refuses to accept a small, early defeat. This chart illustrates the anatomy of a blown account. By removing the stop loss and hoping the price will reverse, the trader allows a minor structural invalidation to accelerate into an uncontrolled hemorrhage of capital. A stop loss serves a precise function. It acts as the absolute non-negotiable barrier separating an ordinary bad trade from complete account ruin. Phase 5 is the aftermath. The margin call hits, the trade closes at a massive loss, and the beginner trader enters a state of deep psychological vulnerability. Driven by anger and a bruised ego, the trader commits the final error, emotional trading. They immediately execute a hasty, uncalculated position, a revenge trade, with the sole intention of winning the lost money back. Revenge trading discards risk management, technical analysis, and structural rules entirely. The position sizing is often doubled, directly precipitating the final destruction of whatever trading capital remains. Attempting to punish the market through emotional force ensures that the market will enact a heavy financial penalty on the trader. Extracting consistent returns from foreign exchange requires recognizing a difficult truth. Success depends on outsmarting your own psychological impulses, not outsmarting global banking institutions. True professional trading operates on strict parameters. It is highly disciplined, devoid of ego, and intentionally, systematically boring. By eliminating these 5 chronological errors, the primary objective of trading shifts. The goal moves from extracting quick wealth to simply surviving the learning curve long enough for compounding skill and disciplined execution to take effect. To build a solid foundation in institutional-grade risk management and trading strategy, subscribe to the Forex Alert.